Great. Thanks so much, Heather. And it's great to be here with all of you today and with my partner in compliance, Dot. We have a lot to talk about today. So much has happened recently with all of the new guidance and, under the ARPA and the CAA. And so that's the main thing we want to talk about today, focus on all the new things that have happened. But first, we'll start out just to kind of give some background. We're going to start out with the big picture view of the big, key compliance developments for health and welfare plans and insurance in 2021. So we'll take a bird's eye view of kind of everything that's happened this year thus far, so you can get some context of kind of where we are. And then we're going to zoom in a lot, actually, and first talk about a topic that we know is really on most of your minds, which is the new ARPA COBRA subsidy guidance. We've had so many questions from all around the country on that, so we're going to really zoom in on that today and talk a lot about that. And we'll also talk about some other new guidance that came out under the ARPA, the American Rescue Plan Act of 2021. And then we're going to switch to talk about some of the new guidance under the CAA, the Consolidated Appropriations Act of 2021, and go into some of that for a little bit, and then discuss some other significant developments, and lastly, give some key takeaways for employers and plan sponsors out there. So let's start. I'll go ahead and get us started. And with this bird's eye view of, and here you see Washington, D.C., of course, a bird's eye view where all the regulatory sausage is made. And it's been a very busy year thus far. We have been just had a ton of rules to read. It has not been slow. That's one way to put it. And really all of this kind of kicked off, I would say, this year with the Consolidated Appropriations Act of 2021, or CAA, which was signed into law on December 27th of last year, and really has been kind of, covered a lot of the big themes that we're talking about today. It talked about a lot about healthcare transparency. It talked about mental health parity. There's a lot in there that's relevant to what we'll be talking about today. So we'll go into more of that later. And then, of course, looking at kind of what happened next, right? We all know, Joe Biden became president. The Biden administration really, in those first couple of weeks after he became president, signed a series of executive orders and executive actions that were really designed to, really designed to kind of roll back what the Trump administration had done. And, what the president said is he wanted to restore the Affordable Care Act to what it was before the Trump administration, right? To really kind of bring the Affordable Care Act, the ACA, back to what, the way it was when it was signed by President Obama, right? The original form of the ACA. And, what you might call Biden care, right? The beginnings of Biden care, right, is sort of the new healthcare policy agendas. And so as part of that, the president signed executive orders creating a special enrollment period and beginning in February through May and through March. I think it was February 15th through May 15th, and basically began to just really, make things a lot more like they were during the Obama administration. He also signed an executive order that rescinded Trump executive order that had made it easier for employers to set up association health plans and short-term plans and all kinds of things that would make it easier to kind of get around the ACA. And one of our clients, I think, put it really well, and they said it's like he's trying to get the Obama band back together. So in many ways, that's a good way to think of it, right? It's kind of like the Obama administration is a band. They're coming back together, and they're kind of taking us back, right, to the way the ACA was intended to be before the Trump administration. And then in February, more things started to happen. We got some clarifying guidance under the CAA about the new rules for health FSAs and DCAP FSAs. So under, just as background, right, we talked about this at the last webinar, right? The CAA made things easier to, create a lot of different relief rules that were voluntary or optional for employers, where they could, expand their health FSAs and decap FSAs in certain ways, make it easier for employers to roll over, carry over monies. And so we got some clarifying guidance beginning in February. And then at the end of February, we got guidance on what we call the outbreak period rules. Those are rules that were initiated by the Department of Labor and the IRS. And those rules really created a pause period, so to speak, a time period when compliance deadlines would be paused to give participants more time to complete different things and different responsibilities, to file claims, to elect COBRA, things like that. And so we'll just refer to those as the outbreak period rules. Today, we talked a lot more about those last time. And then also at the end of February, we got guidance on COVID-19 testing and vaccines, really clarifying the circumstances surrounding when COVID-19 testing must be offered, without cost sharing, and so basically in all cases where you're offering it through the health plan, basically the guidance said it's almost all cases, right, where you have to offer it without cost sharing. It also clarified that COVID-19 vaccines must also be offered without cost sharing, and explained how the health insurance laws have been interpreted to account for the administration of the COVID-19 vaccine. So that was a very helpful piece of guidance. Then, of course, the big thing that happened on March 11th was the American Rescue Plan Act of 2021, or ARPA, which we'll be talking a lot about today, was signed into law. And then just the very next day, New York passed a vaccine leave law allowing for 4 hours of leave, of paid leave, to take a vaccine. And that really set off a chain of things at the state level, where states across the country began to make it easier for employees to take leave to get their vaccines for COVID-19. And then on March 26th, the IRS issued guidance clarifying that COVID-19 PPE, including masks and gloves, could be medical care expenses under the tax code, so that they could be reimbursed under different types of health plans like HSAs, things like that. Obviously, making that a lot easier for people to get masks and to get masked up. April 2nd, we saw the agencies issue guidance on mental health parity compliance under the CAA, which we'll be talking about more a little bit later. And then on April 7th, the DOL issued model notices under the ARPA for how to handle the COBRA subsidies under the ARPA, as well as some FAQ guidance that was really more in many ways geared toward participants, but still very helpful in helping us understand the new COBRA subsidy rules. And we'll be talking more about that later today. And then on April 21st, we reached really a big milestone in the pandemic with 200 million vaccinations, which was double the goal of the Biden administration by that point in time. And at that time, the president really urged employers to offer paid leave and incentives to get the COVID-19 vaccines, which really kind of really move things even further forward for employers who were kind of on the fence about whether they should really do it or not. April 22nd was also, April 21st of 2021 also was a big day. We got paid leave guidance under the ARPA, which we'll be talking about more a little bit later today. And then, of course, at the end of April and early May, Congress began work on the American Jobs Plan and the American Families Plan, which are really the two, these laws are the next. So first of all, these laws have not been passed. These are proposed pieces of legislation. And these laws are really the next two big installments of the Biden administration's economic relief package, or economic agenda. And the American Families Plan is really the most significant for purposes of employee benefits. And the proposed legislation, at least in its current form, would make permanent the expanded health insurance tax credits available for individuals on exchanges in the ARPA. It would also, and then of course, according to the White House fact sheet on that, these credits are providing premium relief that are lowering health insurance costs by an average of $50 per person per month for 9 million people on the exchanges, and will enable 4 million uninsured people to gain coverage. So they're really, promoting that right now. And trying to get that into place. But perhaps most importantly for our purposes, the American Families Plan also seeks to expand paid leave, and really it creates a comprehensive federal paid leave program. And under this legislation, as proposed, workers would receive a minimum of 2/3 of average weekly wages, up to $4,000 per month, and for time off for the birth of a child, to treat a serious illness, care for an ill family member, to handle a family member's military deployment, or handle issues related to sexual assault, stalking, or domestic violence. And by the 10th year of the program, workers would receive 12 weeks of paid leave. The program also calls for 3 days of paid bereavement leave per year, beginning with the first year of the program. And funding for that would be, for this law, including paid leave, would be offset by tax increases on Americans making over $400,000 per year, and the elimination of lower tax rates on capital gains and dividends. So that's really something they're working on very closely right now in Congress. But it may still be a few months away while Congress is handling all the details there. So not necessarily happening next month, but something we're watching very closely. And so then a lot of things really happened in that, between May 5th, May 10th, relevant to employee benefits. The DOL withdrew independent contractor rules issued by the Trump administration that were designed to make it easier for employers to comply with those rules and essentially to classify workers as independent contractors. The DOL found that those rules were inconsistent with and created tension with the Fair Labor Standards Act and withdrew those. Also, the IRS issued guidance explaining the DCAP tax rules, and that was really a big help for for a lot of our clients. The IRS talk really more about the federal tax treatment of the DCAP benefits that continue to be available in taxable years ending in 2021 or 22 because of either an extended claims period or a carryover that was offered pursuant to COVID-19 relief provisions in the CAA. And just because we're not going to have time to talk about it today, I'll just briefly talk about that. That guidance explains that amounts that were available under an extended claims period or carryover provision that would have been excluded from employees' income if they had been used during the taxable year ending in 2020 or 2021 will remain excludable if used for dependent care benefits during the following taxable year. And further, those benefits are not counted toward the maximum DCAP exclusion amount that applies to other DCAP benefits available for the 2021 and 22 taxable years. And the guidance also explains how the temporary increase in the maximum DCAP exclusion under the ARPA affects non-calendar year plans. So just as a little bit of background here, under the ARPA, the maximum amount of DCAP benefits that can be excluded from income is temporarily increased from $5,000 to $10,500 for taxable years beginning in 2021. But because the increase applies to an individual's taxable year, which is typically the calendar year, not the plan year, the increased exclusion amount will not apply to a non-calendar year's DCAP's reimbursements for expenses incurred in the 2022 portion of the 2021 plan year. This is only for non-calendar year plans, remember. So that would be the plan year beginning in 2021 for the non-calendar year plan. So, for example, if a non-calendar year DCAP reimburses more than $5,000 for the 2021 plan year, right, that year beginning in 2021, a portion of the employee's DCAP contributions for that plan year may become taxable if used to reimburse expenses incurred in 2022. So that's an important thing to take into account if you have a non-calendar year plan. That's really helpful guidance. So let's talk about some of these other things that happened at that time. The HHS clarified ACA 1557 rules, which basically made it clear that sexual orientation, that discrimination would be discrimination on the basis of sexual orientation or gender identity would be enforced. Basically, if your plan is making is subject to ACA 1557 because it gets government funding, then if your plan is discriminating on the basis of sexual orientation or gender identity, it can face fines and penalties from HHS. And then on May 10th, the FDA granted emergency use authorization for the Pfizer-BioNTech COVID-19 vaccine for ages 12 through 15. And then shortly thereafter, the CDC issued guidance on masks for vaccinated individuals, making it easier, essentially saying that if you're vaccinated, you should feel safe being indoors or outdoors, which then caused all of the states to issue their own mask guidance. and really kind of create a lot of open questions for employers, creating masking policies in the workplace. Since that's obviously, it could be a subject of a whole other webinar. So we're not going to really go, dive into that today, but definitely very interesting development. And then, of course, most recently, the IRS issued guidance, approximately 24 hours ago, a little more than 24 hours ago, on the COBRA subsidies under the ARPA. And we're going to be doing a big sort of a high-level overview of that today. We're going to be talking about that and some of the examples that were given in that guidance about what you can and can't do. But we'll be focusing much more in detail on that at our next compliance webinar presentation, which will be at the virtual conference, EB Rise. We'll talk more about that later as well. So, Dot, do you want to get us started and tell us a little bit about, give us some of the background and tell us about, how that works with the new guidance that we just received for the COBRA subsidies under the ARPA?
Sure. Sounds good, Dan. So first we want to just talk, again, just about some background. I'm sure everybody is aware of these, but we just want to, just run through. Obviously, the first thing that everyone is aware that the COBRA subsidies are 100% COBRA subsidy for a specific period from 4/1/21 through September 30th of 21. Premiums reimbursed to an employer, plan, or an insurer via payroll tax credit. So essentially, the COBRA beneficiary for that period of April 1st through September 30th would no longer be remitting payments to the COBRA vendor or to the employer. And those premiums will be reimbursable to, again, the employer, the plan in the situation of a multi-employer plan or insurer through a payroll tax credit. These extensions or these subsidies do not extend the normal COBRA coverage period. So if somebody was eligible for 18 months due to a involuntary termination of employment, they're still eligible for 18 months. So, if it happens that their 18 months of COBRA ends in the middle of the COBRA subsidy, let's say, that 18-month COBRA expires in July, their subsidy also would end in July. So, and additionally, and we'll talk a little bit more about this at the outbreak period, those pausing periods do not apply to the extensions of the subsidy. So those pausing periods where individuals could have a delayed date or, up to a year to make a COBRA election, they do not get that same extensions to apply for the COBRA subsidy. Probably the most important and the most confusing thing is that to receive the subsidy, the COBRA event must be an involuntary termination of employment or a reduction in hours. Reduction of hours is either voluntary or involuntary. So that means, initiated by the employee or initiated by the employer. But specifically for termination, it is an involuntary termination. As far as examples of reduction in the hours, that could be due to a change in a business hours of operation, a change of the employee from full-time to part-time status, taking of a temporary leave of absence, or an individual's participation in a lawful labor strike. Another important piece is that the employee is not eligible for the subsidy if they are eligible for coverage under another group health plan, which does include a spouse's plan or Medicare. The qualified beneficiary must provide notification or attestation to the fact that they are not eligible for coverage, or that coverage has subsequently terminated. And we're going to talk a little bit more about this when we get to those newer FAQs, because this, we got a lot more information on that. And then last thing to understand is that these rules are very similar to the ARA COBRA subsidy that we had back in 2009. So we had, very similar rules. A lot of the definitions that we're going to be talking about, really are the same. Okay. The subsidies, let's talk specifically about the subsidies. So they did confirm, sorry about that, guys. Oh, sorry, who is an AEI individual. So the term AEI eligible. Assistance eligible individuals are those whose voluntary termination or reduction in hours occurs during the following time periods. So somebody, an AEI, has a involuntary termination or reduction of hours, specifically during the subsidy period, 4/1 to 9/30. Let's say, for example, the employee was involuntarily terminated on 4/15/2021, and their coverage ends on 4/30/2021. This individual would be eligible for both COBRA and the subsidy beginning as of May 1st. The next period would be prior, if someone had an involuntary termination or reduction of hours prior to the subsidy period, but they have an existing COBRA coverage extending into that period. So meaning that they were eligible for COBRA prior to the subsidy, they remain eligible for subsidy, and they would also be eligible for that subsidy. So for example, let's say an employee was terminated on January 15th, their coverage ended on January 31st. This individual enrolled in COBRA coverage effective 2/1/21 and remains enrolled. They would be eligible for the subsidy as of April 1st through 9/30. And then once September has ended, they would then continue on with the additional months of their original COBRA election period, just without the subsidy. And then there's also a subset of individuals who, again, also had a involuntary termination or reduction of hours that occurred prior to April 1st, but where that individual chose not to enroll in COBRA, or they enrolled in COBRA but subsequently terminated that COBRA prior to April 1st. These individuals will be permitted to receive a second election notice period called an extended election period, where they would be able to prospectively now elect COBRA, either for the first time because they denied coverage, or enroll in COBRA again if their period had previously terminated. So same example as above, we have an involuntary termination on January 15th, and the coverage ended on 1/31, but this individual chose not to elect COBRA. Again, this individual could now make a prospective COBRA election effective as of 4/1/2021 and would be eligible for the subsidy. And then the other thing to understand with these kind of second election periods is that it also includes spouses and dependent children. So even if the employee does not elect COBRA, because a spouse and dependent, if they were on the plan the day before the COBRA qualifying event, they have independent rights to elect COBRA. All right, so let's talk now about some additional questions that the FAQs from April 7th did confirm for us. So they did confirm that the 100% subsidy does include the 2% administration fee, but again, applies only for that period from April 1st through September 30th. Employees or the individuals must self-attest to their AEI status. So the employer can require the employee, to complete a form confirming their involuntary termination and their eligibility, whether or not they, do or do not have other employer coverage, spouse's plan, or Medicare. The FAQs also did confirm for us that the subsidy rules do apply to individuals on state mini COBRA coverage. And as just quick background, mini COBRA coverage, or what we call state continuation coverage, is the coverage that is similar to COBRA that some of the states, actually a lot of the states, probably over 40 states, have mini COBRA regulations, where for those employers who are usually smaller employers, under 20 employees, and who are not eligible for federal COBRA. So it's giving those individuals the same right to have this 100% COBRA subsidy. But the one piece that the regulations did clarify, though, is that for the mini COBRA, that there is no application of that second chance election. So in order for an individual who is on mini COBRA state continuation coverage to be eligible for the subsidy, they actually have to be currently enrolled in that state plan. So there will be no, notice to them and that opportunity to prospectively elect that coverage. We do still have some confusion on whether or not this mini COBRA really applies to a different type of state continuation. Examples of this would be California or New York, where those states extend really federal COBRA. So it really extends coverage for those larger employers who, get 18 months of COBRA. New York does extend an additional 18 months. So still a little confusion about that as far as the term mini COBRA. Does that really mean just for those groups under 20 that are not eligible for eligible for COBRA, or would those state continuations also apply? They also confirmed that once the individual has gotten through their subsidy period as of 9/30, if they did not want to continue COBRA at the going back to and paying 100% of that, that there would be a special enrollment period at the end of that subsidy for an individual to make an application and enroll on exchange plans. They also confirmed that employers have the option of allowing an AEI to enroll in another plan coverage other than the one that they were originally eligible for when their COBRA qualifying event happened. We don't see this very often, and I would think that most of our groups are not permitting this change. Because again, it is completely optional to the employer. And the question is, why would an AEI want to change to a lower cost option? Well, probably maybe because, they really do want to have COBRA past the subsidy period. So once, they get through September, receive their last subsidy, if they're going to need that coverage and they're going to planning on continuing with COBRA, maybe they would want to, find a cheaper plan. But again, completely optional to the employer. And then finally, the FAQs, as Dan explained, do explain how all of the, what the new model notices are and how they work. So we're going to talk about that next. All right. So seems to be, 4 notices and then this summary of the COBRA premium assistance. So first notice we want to talk about is the general notice. And this notice is used for any qualified beneficiary who has a COBRA qualifying event during the subsidy period from April 1st to September 30th. This notice will include information about the availability of the premium subsidy. Please note that this notice does go to all individuals who have a qualifying event, regardless if they would actually be eligible for the subsidy. So, all COBRA notices that are sent out between April 1st through September 30th would, receive this notice, and then it would be a determination on whether they truly are an AEI. The employer must follow normal timing rules for providing this COBRA notice. So it's the same 60 days from the loss of coverage. The second notice is the notice of extended election period, or what we call the second bite of the apple. So this is the notice that would notify a participant that, again, had a COBRA qualifying event prior to April 1st, and they either declined that COBRA election or they enrolled in COBRA and subsequently terminated that COBRA coverage. So, and it also must be distributed to those currently enrolled in COBRA effective as of April 1st. This notice also provides information about the subsidy and as well as the opportunity to elect COBRA if not already enrolled. The AEI who is eligible to elect pursuant to this extended period may elect coverage prospectively beginning as of April 1st, 2021. So, even though they never made an election, they have no requirement to retroactively enroll to their original date, pay all these back premiums. They, again, can make that prospective election starting April 1st when the subsidy begins. This notice does not have to be provided to qualified beneficiaries who lost coverage due to other qualifying reasons like divorce or aging out of the plan. And it has that 60-day requirement from the start of the ARPA rules. So that due date must be provided by May 31st, 2021, which is coming up fast. And we know a lot of our employers are working with their COBRA vendors to, absolutely meet that date. And then there is, I'm going to skip around a little bit and talk about the summary of COBRA premium assistance. So this is provided to qualified beneficiaries who receive either one of the first two notices. So this gets sent with the general notice, also gets sent with the notice of extended election periods. This summary notice includes the form for individuals used to claim their status as an AEI and the form for notifying the plan of subsequent ineligibility for the subsidy if that individual, at a later date becomes eligible for other group health plan coverage or Medicare. The next notice is the notice of expiration of period of premium assistance. So this is a little bit different than general COBRA, where there really is no notification, to the COBRA beneficiary that hey, you're coming up on your 18 or 36 months. So this is a notice that would advise the participant that, that the end of their COBRA maximum COBRA premium assistance is coming up. This notice must be provided at least 15 days, but not more than 45 days in advance of the expiration of the AEI's COBRA premium assistance. And then the final notice is the alternative notice. This is, probably similar to the general notice and the notice of extended election period. Well, actually just the general notice. And this is for insured coverage for those state mini COBRA elections or mini COBRA eligibility that occurs between April 1st and September 30th. All of these sample notices and the summary of notice as well as instructions can all be found on the DOL's website, which we have listed here for you. Okay. Let's talk about penalties. What happens if you have situations where employees are not doing what they're supposed to, and also, what employers are doing. So the FAQs did clarify that there are separate penalties for the employees. So an employee who fails to notify the plan of eligibility for other coverage, that would be a $250 for each penalty. If the individual fraudulently fails to notify the group health plan, the individual is subject to a penalty equal to the greater of $250 or 110% of the premium assistance improperly received after the end of the eligibility for COBRA premium assistance. The penalty will not apply if the individual's failure to provide notice was due to reasonable cause and not due to willful neglect. But also note that the employer, plan, or issuer who receives the premium assistance credit in the amount of the excess premium has no right to the penalty payment. So unfortunately, if an employer gave a COBRA subsidy, inappropriately to an individual, they were not aware that that person was not eligible at the time they provided that. Unfortunately, if that individual is penalized, that money goes, assuming to the government, and unfortunately not to the employer.
Right. It goes to the government, but they still, if they didn't have any knowledge of it, they can still take the tax credit, which is good.
Yes, correct. So, yep. Yeah, great. And then the tax treatment for the employees, it's excluded from gross income, so there's nothing to report on the employee's W-2, completely tax-free. And then penalties for the employers, if an employer fails to send out the notices or, fails to act per the regulation, they can be penalized as much as $100 per qualified beneficiary per day, but no more than $200 per family member for each day of noncompliance. So if you have, a single, it's $100. If you have an employee, a spouse, and a dependent child, even though that could be $300, they're maxing it out at the $200 per family. And the tax treatment from the employer, it is just a refundable tax credit to the plan, the employer, or the insurer. All right. Moving along, let's talk now, and Dan's going to help me with this one. As he said, these rules, of course, just came out less than 24 hours ago, but at least we got them prior to our webinar. So, and these rules are, they provided many more rules. The notice itself is 41 pages. I think there's, I don't know, Dan, how many? 54, 84 FAQs.
I think it's like 84. I think it's around 80 something.
Really, yeah, that really go into, what these, a lot of these unanswered questions for us. So probably the most asked about question that we received is, what does involuntary termination mean? What does it mean? And as a lot of the law firms had been reporting all along, they are using the same definition of involuntary termination as did occur with the 2009 ARA.
They predicted that. They didn't report, they predicted it. I think we should clarify. They were all saying, we think this is what's going to happen. We think that they're going to use the ARA definition. And then they, from 2009, and then they went ahead and that's exactly what they did.
Right.
Yep. So, yeah.
Yep. And so the real formal, the basic definition means a severance from employment due to the independent exercise of the unilateral authority of the employer to terminate the employment, other than due to the employee's implicit or explicit request where the employee was willing and able to continue performing services. And then also they clarified that the determination of this involuntary is really based, on a facts and circumstances kind of situation.
Yeah, they look at all the facts. Yeah. You want me to give some examples?
Yeah,
I can jump
sure.
in. Great. Yeah. So yeah, like Dot said, right, they're going to look at all the facts and circumstances that are relevant to the termination of employment and saying, was this an involuntary termination of employment or not? And I think this is a big relief, at least for most of our clients that Dot and I have been speaking to, which is that, there was no definition all this time, right? We're only days away from the May 31st, deadline on notice on the stuff. And it was like, how do we even define what an involuntary termination was? It didn't say anywhere in the statute, didn't say it anywhere. And then finally, just, the late afternoon on May 18th. So, literally like, approximately, a day ago, right? We got this definition that Dot just read. But what does that really mean? So let's break this down to some real examples here. So what happens if, will it be an involuntary termination of employment if an employer terminates an employee while he or she is absent from work due to an illness or disability, right? It's something they always tell you not to do that, right? But actually it will be. Generally speaking, yes. So the new guidance that we got on the 18th clarifies that an employer's action to end an individual's employment while he or she is absent from work due to an illness or disability, will be an involuntary termination if before the action there's a reasonable expectation that the employee will return to work after the illness or disability has subsided. So that's a yes. How about involuntary termination of employment? Does that include a death of the employee? Well, that's a no. And I think that seems pretty clear to us. That's the way it was under the ARA from 2009. So death is not involuntary termination of employment. What about retirement? So ordinarily, no, retirement would not ordinarily constitute an involuntary termination of employment, but it could do so where the employee was willing and able to continue employment and had knowledge that they would be terminated, absent the retirement. So in other words, if they kind of know that it's like, if it's sort of labeled as retirement to get around the fact that the employee knows that they're going to be terminated, right? You can't just use that label to kind of get around it. That's something that's kind of consistent with a lot of what was said in this recent FAQ guidance from May 18th is, you can't just sort of label it as voluntary and hope that that's going to work, because like we said before, right, the IRS is going to look at all of the underlying facts and circumstances to see what really happened and determining whether it was involuntary or not. So let's look at another example. Does involuntary termination include termination for cause, right? Like a just cause termination or termination for cause? The answer is yes, but not for what's called gross misconduct. Now that would also apply just for regular COBRA, right? Not just for getting a COBRA subsidy, but right, if an employee is terminated for gross misconduct, then you would also just not be eligible for COBRA. But we really want to remind everyone that that's a very hard standard to prove, and many courts have basically decided on what that standard is going to be, and it's an extremely high hurdle to jump. You have to do something very egregious, cases of situations where an employee was selling drugs at work. Let's say like an employee one example, an employee working at a pharmacy is selling drugs, and not the drugs he's supposed to be selling, things like that. Doing things that are really, really, really egregious. Workplace violence, things like that. So in most cases, gross misconduct is not going to work. A judge will not uphold that. And so we would really caution strongly against using that standard to get around this.
And
what about,
Dan,
go ahead.
One thing you and I talked about too is that we got this question, about gross misconduct, where some employers were trying to use the gross misconduct to, not provide the COBRA subsidy, but they had initially been providing COBRA. So it can't be one or the other. So if you did offer COBRA, and for a situation that you considered gross misconduct, you can't now deny them the COBRA subsidy as well. So just a quick, because we did get a lot of questions about that.
Yeah, definitely. Yeah, that's a great one. And let's also just talk, we have a lot of different examples from the guidance. So let's talk about one of the big ones where there was a lot of questions on, which was contract workers. This is one of the ones where, it was very unclear as to how the IRS would interpret this. So the IRS said that an employer's decision not to renew an employee's contract, if the employee was otherwise willing and able to continue working, and was willing to either execute a contract with terms similar to those expiring or to continue employment, right, that would be an involuntary termination. However, by contrast, right, the expiration of the contract that was for specified services for a specified set term, where the parties to the contract understood that it was not to be renewed, right, at the time of contracting, that would not qualify as involuntary termination of employment. So it really depends on the circumstances there. And that was a very frequently asked question. And then let me also briefly talk a little bit while we're talking about the new guidance. I can go through and talk about substantiation and documentation requirements, because that's also a hot question that I think, hot topic that employers want to know about. So the IRS clarified that in order for employers to claim the tax credit, they have to retain documentation to substantiate that the individual was eligible for the COBRA premium assistance. And the IRS clarified that that can include collecting the employees' self-certifications or attestations, where, remember, that's what Dot talked about. Those are available on that summary form, the summary of COBRA premium assistance form, in those model forms that were provided by the DOL. Or they can more simply retain an employment record, the documents that such employees experienced in involuntary termination or reduction in hours, and that they're not eligible for other group health plan coverage or Medicare. And then the IRS also clarifies that employers' reliance on such attestations or self-certifications is permitted so long as the employer doesn't have actual knowledge that the information provided is incorrect. And that's something I just kind of mentioned earlier, right, which is that, you can still, for substantiation purposes, right, as long as you have that, you don't have any knowledge as the employer of what really is going on. Like, let's say the employee actually is eligible for Medicare, but you don't have any knowledge of that as the employer, that's perfectly fine. You can still keep your substantiation and claim the tax credit, and you'll be okay. Dot, you want to take it from there and kind of wrap up all the new guidance discussion? Great.
Sure. So the other item that we got a lot of questions and the guidance did explain, is how eligibility and enrollment in the other coverage affects subsidy eligibility. So is just being eligible for this other coverage, but they did confirm that if the individual would be eligible for other coverage but currently has no enrollment right, meaning they had a termination of employment and coverage, 6 months ago, they're now trying to enroll for the COBRA subsidy as of April 1st. Even though they were eligible for their spouse's plan, there is no current way for them to get onto their spouse's plan, that person would still retain eligibility for the subsidy. Also waiting period. So, an employee is working at a new employer, they have a 90-day waiting period, but, they still could be eligible for the COBRA subsidy during that waiting period. The FAQs did clarify that the subsidy is available for vision only, dental only, and HRAs. It also explains that the COBRA subsidy could apply to an employer who no longer is subject to federal COBRA, but that if the employee experienced an involuntary term of employment or reduction in hours while subject to federal COBRA. So this would be, a larger employer, one that, let's say, has 50 employees. They were subject to COBRA last year. They've reduced their workforce. They're now under that 20 mark, even though they're no longer eligible or subject to federal COBRA. Those individuals at the time of their termination of employment was eligible for COBRA. They also did explain the overlap between ARA and the IRS outbreak periods, which I did explain again that that the individual does not get the extension pausing period to make an election for the subsidy, but still could make that election for their original COBRA. Also talked about to confirm again that spouses and dependents can make an independent election. So, for example, an employee who had an involuntary termination of employment or reduction in hours before April 1st, but who would have been an AEI if the election were in effect, and who elected self-only coverage, which later lapsed. That individual, even though maybe that employee is not going to apply for the subsidy as of April 1st, if that employee had a spouse and dependent who were on the plan, though that spouse or dependent could make an independent election and be eligible again for a prospective COBRA coverage period beginning April 1st, as well as be eligible for the subsidy. And then also just goes into detail, about exactly how does, the premium payees receive this tax credit, as far as submitting that through their payroll taxes and an additional IRS forms. All right. Well, that's everything related to COBRA. So I think Dan's going to talk to you guys now about the paid leave under the ARPA rule.
Yeah. So one of the big things, when the ARPA was signed into law, there were 9 states and the District of Columbia that had enacted their own comprehensive family and medical leave laws. And this is independent of a federal law. So there was a real big push to do something from the federal standpoint in the ARPA. Although now, of course, as we talked about earlier, to do something more permanent, they're looking now toward that American Families Plan proposed legislation to include the more sort of permanent paid leave laws. But for the time being, there's a real need for uniformity here. And so what they did was, basically at the very beginning, an FFCRA, had mandatory paid leave for certain emergency paid sick leave or paid FMLA for employers with fewer than 500 employees. That went through December 31st of 2020. And then subsequent legislation extended that to March 31st. And then the ARPA extended it to September 30th for voluntarily providing leave. So the employer could voluntarily provide leave through September 30th and get tax credits for it. The new guidance under the ARPA clarifies that employers can get an extra extra tax credits for up to 10 days of emergency paid sick leave. That's in addition to the credits for 10 days of paid sick leave originally provided under the FFCRA. And then with regard to expanded FMLA, paid FMLA, the employee is still limited to 12 weeks of EFMLA for the entirety of the leave period, right, through September 30th of 2021 for that voluntary leave. But now, under the ARPA, a tax credit has been increased from $10,000 to $12,000 for the paid FMLA leave. And then, of course, the big thing here was that the leave for vaccination, right? Employees can now take either of these types of leave, paid leave for obtaining COVID-19 vaccines or recovering from an illness or injury related to COVID-19 vaccines. So that was very helpful. Also, this guidance clarified how you claim the tax credit on the Form 941 for that paid leave. And I'm going to go real quickly here through some of the other new guidance that we got from the CAA. First of all, we did get guidance clarifying how the mental health parity rules work under the CAA, and the CAA requires group health plans, insurers, and issuers that cover mental health or substance use disorder, and medical surgical benefits to prepare a comparative analysis of any non-quantitative treatment limits, or NQTLs, that apply. And then effective February 10th of this year, under the CAA, plans were required to supply this analysis and other information if it was requested by federal regulators, including the DOL. So, what are NQTLs, right? Those are generally, they consist of any limitations on the scope and duration of benefits that are not expressed numerically, things like medical management standards that limit or exclude coverage based on medical necessity, prior authorization requirements, things like that. And so what you had to do here is, you had to create this 5-part analysis, and if it was requested anytime February 10th or later, it had to be provided to the regulators. Now, fortunately, we do know that this only applies to self-insured plans. The carriers will handle it for fully insured plans. It has to be available, like I said, February 10th. If the agency finds any kind of non-compliance, they will give you a 45-day cure period. And the agencies did provide future guidance, on April 2nd, explaining that there has to be some real meat on the bone here in your NQTL comparative analysis, right? You're comparing how NQTLs apply between mental health versus other medical benefits. And now the other good news, in addition to the fact that this only applies to self-insured plans, is that what we found is that many of our self-insured plan clients already have the carrier or the TPA that they're working with has already prepared this and has this ready. So it's not a major burden for the employer and plan sponsor. In most cases, it's already kind of been prepared because there have been rules at the state level already requiring this. And one other thing that we know is coming soon is, go ahead. Yeah.
Sorry, real quick, Dan, just wanted to let everyone know that a little interesting is that last week we did have a group receive this request from the EBSA. And it's interesting because the plan was a fully insured plan, not a very large plan. It's not a 10,000 life group plan. It wasn't self-funded. It was actually fully insured. So, the insurance carrier will be providing that. So just interesting that, we did see that. Just wanted to let everyone know this isn't, a regulation that's, just kind of
just
out
on the
there
books
and they're
not happening, right? Exactly.
Right.
So we did also find out that there will be, just from our inside Washington sources, we did find out that there will be some guidance coming out soon under the CAA on fee disclosure that did not get released before our webinar today. But I think, Dot, if you want to just briefly talk about some of the main requirements here, we can talk briefly about that as well, just so they have some background for before that stuff comes out.
Yeah, so we did talk about this on the last webinar. So this is a requirement that brokers, consultants, and other plan services providing services to an employer, that they are required to make a disclosure of those fees if that broker or consultant does receive $1,000 or more in total annual or indirect compensation. So, compensation related to group health plans, medical, dental, vision, EAPs, HRAs. There's specific definitions on what those categories are. And it's important to know that this is a fiduciary responsibility to ensure on the employer's part that the broker is providing that information. It's kind of it falls under the ERISA prohibited transaction. And so key takeaways for these are, that each employer should identify their consultant brokers, which are providing, these type of brokerage or consulting services, determine whether they receive direct compensation or indirect compensation, and then definitely be prepared that beginning January 1st, 2022, to be requesting these from your broker.
Right. And I think one of the things that the reason why this was created was that a lot of brokers and consultants out there were taking a lot of money from, healthcare consortiums and other third parties and not disclosing that on their fee agreements. And I think that's one thing that really has differentiated us from the competition, and for over a decade, virtually all of our clients have had a comprehensive and detailed brokerage and consulting service agreement or other service agreement that's met the standards of these CAA fee disclosure rules. So, and we will be, making sure all clients have that before the deadline. So it's something we've always prioritized, the fact all of our, service agreements are easy to understand, and we're very transparent about our costs and services. And that's something we really take pride in here at Corporate Synergies. A couple of real quick developments that happened. I'll go quickly here because I know we're getting close on time. One big thing that happened was that the agencies issued cybersecurity guidance for employee benefit plans that talk about really best practices. Really the DOL kind of outlined the major things you need to do to mitigate cybersecurity risks when you're administering your ERISA covered benefit plans. And a lot of these things are things that it really things that I think most employers out there kind of know that they should be doing. And so a lot of this was sort of things that nothing really surprising or new here, but things like maintaining a written cybersecurity plan, conducting annual risk assessments and third-party audits of security controls, as well as having a team that's ready to, with defined roles and responsibilities in the case of a breach, right? Those are things that should be done, and that I think everyone kind of knows that they should be done. So in many ways, it was kind of like a review or sort of a, overview of best practices to be, making sure that you're doing with respect to your plans and, of course, service providers to your benefit plans. Okay, finally, we wanted to talk about something I know that's been on everyone's minds a lot, which is incentives to get your employees to get the COVID-19 vaccines. And as you may recall from our last webinar, we talked about last time the fact that the Biden administration had frozen the Trump administration's EEOC wellness incentive rules, which had only allowed de minimis incentives like water bottles or a pencil for wellness plans that were subject to the ADA or GINA. And so those rules were invalidated by the Biden administration and until they could be further reviewed by the Biden administration. While we're still waiting for their review of those, there's this new ambiguity or gray area about what you could do or could not offer as a financial incentive through a wellness program for vaccines, and like a vaccine, especially for a COVID-19 vaccine offered through a wellness plan. So it created a lot of confusion. And then really beginning in April, the Biden administration has been very vocal, including President Biden himself, urging employers to offer financial incentives to employees to get vaccinated. And in light of that, it makes it now much easier for organizations to offer such financial incentives outside of a wellness plan, so long as your organization is consistent with the current agency guidance, allowing for reasonable accommodations for individuals with disabilities and sincerely held religious beliefs that prohibit them from getting vaccinated. So for example, if you're offering, let's say, a $50 gift card to all employees that get a COVID-19 vaccine, it would be a good idea to also create a reasonable alternative standard that employees can still meet and still get that $50 if they can't get the COVID-19 vaccine due to their disability or sincerely held religious belief. So I think it's really good news for a lot of employers who wanted to do something. They wanted to offer some kind of financial incentive, but they were on the fence because they didn't know what the rules would be due to the freezing of the wellness incentive rules. But the administration has now made that much more clear. That's something that you can do. So finally, just to wrap everything up here, some of the key takeaways for today are communicate, right? Communicate with your plan participants, your COBRA administrators, your TPAs, your other plan vendors, but all of these new ARPA COBRA subsidy rules. That was really the focus of today, right? Make sure that they're consistent with the DOL model notices and the notice requirements that you have for other plans. And then also understand how the new ARPA rules work for voluntarily providing paid leave and retaining the tax credits for such leave. And of course, encourage your employees to get vaccinated for COVID-19. But of course, if you're doing that, right, exercise caution, make sure you're providing reasonable accommodations for employees with disabilities and sincerely held religious beliefs. So we also wanted to point you to some helpful resources that where you can find additional information about what we talked about today. Check out our Compliance Resource Center. Formerly it was formerly called ACA Now. Our Health and Welfare Compliance Forum on social media, or HAWK. And then check out our upcoming 2021 events here at this final link, including the upcoming event where we'll be talking a lot more about the new COBRA rules and other things related to compliance. Our virtual forum conference called EB Rise 2. And Heather, first of all, I just want to say thank you to everyone for joining us today. We really appreciate it. And Heather, do you want to tell everyone a little bit more about the upcoming virtual conference? Or actually, I should say Dina, right? I think Dina is
Yeah, that's okay.
Great.
That's okay, Dave. Yeah, Heather was having some technical difficulties, so I'll jump in here. Thank you for that great information. Yes, we have EB Rise 2, our HR and Finance conference that we do annually. That is coming up on June 8th. So you can go ahead and register. If you go to, we didn't put the link up. Heather could probably put that link up in the chat, or you can just go to our events page on our website and you'll be able to register from there. If you have any further questions, please send them through to csg.events@corpsin.com. And we thank you very much for your attention, and please stay well.